Kothari is with us, Managing Director, AlfAccurate Advisors. Rajesh, great to have you back on the program. Thanks very much. We'll talk about what you have in your portfolio, but let me start by asking you what I don't think you have. Do you have a view, or do you happen to own NetWeb, Rajesh? I think we've discussed this when you were in our office for one of those editors roundtable.
No, that was not this company. So we do not own this name. So no comments here. I
see. Have you studied it though? Have you looked at it?
Yeah, we study almost, many companies. So I think what we do is that it's always better to invest in companies which are probably easy to understand, and probably the growth prospects and the visibility, that's something very important. So in this kind of a business, is very important to check the global businesses and the global valuations and the global growth opportunity. So you need to look at it from that matrices and then decide, it's always better a little bit not to get carried away, right? So.
But, if it is the global criteria, then it is very difficult not to buy. Because if you look at it, valuations, of course, everything is more expensive than peer sets abroad. But if it is about AI spends and data centers and hardware and racks and servers, that's essentially what they do. So it's very hard. You're absolutely right. And sometimes, it works out beautifully, because you see something happening globally and then you kind of sort of try to spot what can one do. It's just that it's already done, it is done well. But it was interesting. I asked you that because somebody was likening NetWeb to something what we saw in the EMS space, in the data center, in the Dixons of the world in the early stage. It looked very, stock doubled and then doubled and then doubled. I don't know. The only similarity between both spaces, of course, is that margins are very low. That industry has 3-4% margin. This industry margin is also not very high in that sense. What have you done, Rajesh, though, across your portfolio since we last spoke? If you can give us a brief sense.
So basically, as you are aware, the auto is one sector which we have been overweight for quite some time. And, of course, post-GST is one of the large beneficiaries, the entire GST cut. And what is happening is, because of that, as I was always saying, the content per vehicle, that opportunity to increase the content per vehicle is further going up because of this cut. And therefore, that means that the revenue growth potential for many such companies is much bigger. Also, many of our portfolio companies have entered into the new technology tie-ups with the global companies. And that also opens up one more new segment to cater to, which is a good thing. So that is one sector on which we remain positive. The second sector, which, within banking and finance, the housing is one space which we continue to like. And I think, the growth here is going to be much better compared to the overall banking segment. Third is the specialty chemical, which we have been positive last 15-18 months. And we keep adding to this basket. There are many interesting companies which are becoming reasonably attractive. And also the growth is going to be much stronger over next probably 12 to 24 months. And fourth, of course, is the select pharmaceuticals, because here in the healthcare space, within pharma, we have multiple segments. One is hospitals, which we continue to like. Second is, the domestic pharma business. Third is the CDMO. And fourth is the special opportunities like, the GLP injectable kind of a business. So there are a lot of bottom-up stock picking, which is good from the pharmaceutical perspective. So I think these are the four sectors. If you look at our AAA budding beast, which is since you are talking about more in mid and small cap space, that's basically the kind of sectors what we currently own. Last but not least, of course, EMS is the large, sector weight in our entire portfolio. Be it the large company or even the mid-sized companies, we own across the companies within the EMS basket. So these are the 4 or 5, sectors and the key, what I would say, the leaders who have a strong growth. So our portfolio is a strong growth positioning, and we expect it to continue to deliver 20 to 25% earnings growth for FY26.
Hi, Rajesh. Yes, absolutely. I can see that pharma is actually your largest holding in terms of sectors at almost 16% of this particular portfolio, followed by engineering and consumer. Now, speaking of engineering, you have a couple of large MNCs that you've held on for a while. Right? The likes of Hitachi, and then on the Indian side, the CG Power, which has been one of your key holdings as well. There's an argument in the market whether the time has come to maybe take some money off these industrial and consumer stocks, maybe move some of it to, consumption. Just tell us where you stand there. And what about power? Because the one near consensus theme in the market is power T&D. So some of the companies that you own actually play in that space. But on industrials, and I also don't see, at least in the top 20, I don't see, too much of defense. So is this something you're thinking about, or are you staying away because of valuations or execution risks?
Well, let me come to the first point in terms of the capital goods. So here we play the power proxy. So power T&D proxy, the biggest expenditure, the biggest beneficiary is going to be the HVDC. That's a big opportunity. That's a huge opportunity. And I'm sure you would have read last week, one of the company which you mentioned, which is one of our top holding, the parent company has entered into the AI, kind of a tie-up, for the global company. So the opportunity for this listed space of those, the global multinational, the opportunity is huge. So one can always get tempted whether one should do profit or not. The important is what kind of PEG you are comfortable to buy at. And till the time the earnings growth is going to be 25, 30, 40% compounded over the next 2, 3, 4 years, on PEG basis, you need to keep evaluating, and then maybe you can decide to trim or take some profit book. But we continue to remain bullish on these themes. So that is as far as, the capital goods theme goes. As far as, your EMS space question, again, this is a space which is an interesting space. The opportunity is going to be huge. And while, of course, the stock price have run up, but please keep in mind that every 3 months, new PLI schemes are getting launched. And I think we will continue to do that. So from segment 1 mobile, which happened, 3 years back, to the AC component, which happened after that, to the camera modules, which is happening now, to the hardware side, to the semiconductor side, it is a huge value chain, and we are importing a lot even today. So you will continue to see more categories to be introduced for this PLI. And the companies which are holding, they are the biggest beneficiaries, and are also from the capabilities perspective, they are the right companies who will capitalize on this opportunity. And therefore, on EMS space, I think it is just not 1 or 2 quarters kind of a play. It is a much more, next 2, 3, 4, 5 years play. So that's another space which we continue to like. Of course, you may find it a little bit expensive, but again, when you look at from the PEG perspective, all of a sudden you will find that they are much cheaper. I mean, look at any big companies. They all are trading at, say, 18 to 25 times with earnings growth of 6-7%. So actually, PEG is far, far expensive. So I would like to break that myth that, the large caps are cheap or mid caps are expensive. No, when you look at on PEG basis, in fact, the mid cap will continue to look a little bit more attractive compared to the large cap.
I can see Sirma on your top 20. Do you own the others as well? Amber, Dixon, or only one holding in this space?
So, well, we own Dixon in our multi-cap, AAA IOP portfolio. We own here, a couple of names. As you can see, our large holding is also a semiconductor play. And then, of course, we have a kind of companies, what you mentioned, and then we have another 2 companies which are not part of top 20, but they are next to top 20.
Next to top 20. Got that. Good conversation, Rajesh. Thank you very much for joining in and giving us some perspective on a lot of these themes that we have discussed. You have a